Okay, so we're going to review the minutes from the May meeting. But before we do that, for the Applied Series subscribers, let me just give you a rundown of the calendar from now till August. Starting the end of May, beginning of June, June 3rd, and running for 6 weeks, I have level 3 seminars that I have to do, and they pretty much take me all week to prepare for them. They end July 8th. For the rest of July, I will be adding to the sector studies for financials. I'll be adding analysis of banks, starting with a very simple bank that just has a banking book and building up to a more complex bank that has both a banking book and a trading book. And then once we get into August 16th, the Portfolio Construction and Management Extended Series begins. And this will be a weekly addition to this. And we will start with a very simple, empty portfolio. And every week we will build some complexity to it, along with some positions we'll take. Not hoping to make any money on them, but just to experiment with different types of positions. Maybe we'll do some more complex trades so you can see how they're done, just so you can see the risk involved in doing certain things. So that'll run for an extended period of time. I don't know how long, because I don't know how long it takes me to get through everything. It could be 5 or 6 months of weekly additions to this series. And then after we start that, I'm pretty much done all the requirements I need to do for the level 1, 2, 3 2024 CFA. Then I am on to just the Applied Series. So updates and additions to the Applied Series will continue on into the fall, all the way into January or February of 24 before I got to, jump to CFA to get it ready for the 2025 release. All right, let's have a look at the minutes. I should talk about the aftermarket activity. I'm doing this video at 9 p.m. on a Wednesday evening. I'm sure most of you are aware NVIDIA reported after the bell and just crushed it. So they traded up from, I think, 306, 305, 306 as of 4 o'clock. To as high as 391 in after hours. I think they ended at around 380, which is a huge run up. So I think that is probably going to spill over into the wider market, the whole AI euphoria. I don't know that that is going to be overshadowed by politics or central banks, because it lies outside of the effect of interest rates, I think. And it is a compelling story, and we do see it in our lives. We are hearing about it. Many people have used ChatGPT. There is buzz, there is excitement. The last time I think something had this kind of excitement with these blue sky projections. When I say blue sky, the sky's the limit, right? These blue sky projections of all the things it can do and all the things that it will change. Much like the internet is in the beginning, it was just this blank slate of possibilities without any evidence that none of those possibilities would come to bear anytime soon. And AI will be the same thing, that it will be several years, I think, before it really starts to increase productivity in companies and decrease costs. But it will be a cost increase initially, because you have to deploy it while you maintain the rest of your staff. It'll be a while before you can see that AI can eliminate anything. That's thinking too far ahead. The market won't do that. I think the market will respond to AI. Which is apt, because we're going to talk about the minutes here, is how is a central bank in a situation that it is in now going to respond to a market that might start to behave like the tech bubble in the late 90s. I'm not going to say it will do it, but might start to behave like that. And if it starts to behave like that, if we're seeing increases in companies of $10, $20 every single day, where Microsoft's going up $5, $6, $7 every day. Google's going up $5, and it just keeps going up, and the hype just keeps going. It's interesting to see how a central bank would respond to that. I think it would push them more likely to raise rates. But I don't know that would affect the AI story. So I was faced with a lot of uncertainty these last few weeks as to why is the market not responding to exactly what Fed officials are saying. And even this week, it seemed that they were just shrugging it off. I think they will, the market on whole will continually shrug off what the Fed says. So I'm even more confused at this point. And when you're confused, you get neutral. So today I did spend some time getting neutral with the pullback. I'm not completely neutral, but I did move there. But based on the price action tomorrow and what the euphoria is like, I most likely will try to get as neutral as I can without limiting my short position. I will just take on some long positions. Okay, let's look into this. And as we go through this, the sort of difference there, you can see the stark difference in the members, where some were feeling that we've got to be concerned about this, and others were beginning to feel like no, we are making progress. The staff economic outlook. Remember last time they were projecting a recession. The economic forecast prepared by the staff for the May FOMC meeting continued to assume that the effects of the expected further tightening in bank credit conditions amid already tight financial conditions would lead to a mild recession starting later this year, followed by a moderately paced recovery. Real GDP was projected to decelerate over the next 2 quarters before declining modestly in both the fourth quarter of this year and the first quarter of next year. So they're looking out to the fourth quarter of this year, first quarter of next year. Unemployment rate was forecast to increase this year, to peak next year, and then start declining gradually in 2025. Staff's core inflation forecast was revised up a little relative to the previous projection. Recent data for core PCE goods prices and the ECI measure of wage growth came in above expectations. We know that. Supply-demand imbalances in both goods markets and labor markets were easing a bit more slowly than anticipated. What else do we have here? In 2025, look at that. Both total and core PCE price inflation were expected to be at about 2%. That's the staff. Let's see what the participants decided to say here. In their discussion of current economic conditions, participants noted that economic activity had expanded at a modest pace in the first quarter. Nonetheless, job gains had been robust in recent months, and the unemployment rate had remained low. Inflation remained elevated. Participants agreed that the U.S. banking system was sound and resilient. That's a theme you're going to see in their notes. They keep coming back to that statement, that slogan. It's sound and resilient, sound and resilient. They commented that tighter credit conditions for households and businesses were likely to weigh on economic activity, hiring, and inflation. However, participants agreed that the extent of these effects remain uncertain. Against this background, participants concurred that they remained highly attentive to inflation risks. So nothing has taken their eye off inflation. So if we're thinking that they're concerned about growth, they're concerned about credit, they would have said it in that sentence. They would have said something about against this backdrop, participants have now decided to start looking at this and this, or are weighing that inflation and economic growth concerns are balanced. But they're not saying that. They concurred that they remained attentive to inflation risks. Assessed that the cumulative tightening of monetary policy over the past year had contributed significantly to more restrictive financial conditions. So they're seeing more restrictive financial conditions, and the market did rally through April into May. And at that meeting, they're saying we are seeing more restrictive financial conditions. They're not wagging their finger at the equity market, so maybe they're not too concerned about it. With inflation well above the committee's longer-run 2% objective and core inflation showing only some signs of moderation, participants expected that a period, this is a kind of a nice punch in the face, participants expected that a period of below-trend growth in real GDP and some softening in the labor market conditions would be needed to bring aggregate supply and aggregate demand into better balance and reduce inflationary pressures over time. This is saying, hey, listen, for those of you who are seeing some softening in the economic data and maybe a little bit of drop in wages, job openings are dropping, the quits rate is dropping, that's not enough. What they're saying here is that's what we need. That's what we need. We're not going to cut rates just because we see that, because we're saying in this paragraph, we need that. So they actually welcome it as evidence that what they're doing is working, but that has to continue so that you get the inflation out of the system. Some participants mentioned that access to credit had not yet appeared to have declined significantly since the recent onset of stress in the banking sector. Participants judged that stress in the banking sector would, in coming quarters, likely induce banks to tighten lending standards by more than they would have in response to higher interest rates alone. However, participants generally noted that it was too early to assess with confidence the magnitude and persistence of these effects on economic activity. So they were concerned at the last meeting in the press conference, and we hadn't seen the senior loan officer survey yet. There was concern that, the stresses in the banking system probably did some of the rate hikes for them. But this paragraph starts out, access to credit has not yet appeared to have declined significantly. However, a little too early to tell, but we haven't seen anything yet. Let's go to the sectors here, starting with household sector. Participants noted that consumer spending showed strength in the first quarter, supported by gains in personal disposable income. They also remarked that the quarterly strength was driven mainly by very strong spending growth in January, while real spending fell modestly over February and March, consistent with what we heard some retailers tell us that they did see consumer spending decline into March. Business sector. Participants expected the tightening of bank lending standards to weigh further on firms' capital expenditures. Several participants noted that, based on reports from their district contracts, concerns related to banking sector stress could add more uncertainty to an already soft economic outlook, increasing firms' caution, especially at smaller and mid-sized firms that rely heavily on bank credit to finance their operations. However, some other participants mentioned that developments in the banking sector appeared to have only a modest effect so far on credit availability for firms. Labor market remained very tight. They noted some signs that the imbalance of supply and demand in the labor market was easing, prime age labor force participation returning to its pre-pandemic levels, further reductions in the rates of job openings and quits. Participants remarked that although nominal wage growth appeared to be slowing gradually, it was still running at a pace that, given current estimates of trend productivity growth, was well above what would be consistent over the longer run with the committee's 2% inflation objective. So, how are you gonna solve that problem? Either the participation rate keeps climbing, so you introduce slack in the market, or you have to increase the unemployment rate. So if we see it go from 3.4 to 3.5 to 3.6, I don't know that that's going to cause the Fed to do anything different. Participants agreed that inflation was unacceptably high. They commented that data through March indicated that declines in inflation, particularly for measures of core, had been slower than they had expected. Additionally, participants emphasized that core non-housing services inflation had shown few signs of slowing in the past few months. Some participants remarked that a further easing in labor market conditions would be needed to help bring down inflation in this component. In discussing the likely effects on inflation of recent banking sector developments, several participants remarked that tighter credit conditions may not put much downward pressure on inflation, in part because lower credit availability could restrain aggregate supply as well as aggregate demand. Interesting observation is that, there'll be less credit availability, but businesses borrow that stuff to create supply. So maybe it's not going to help maybe it'll add to inflation by cutting back on supply. And I made this argument last year. Higher interest rates will not increase the supply of housing. It will not. We have a housing shortage in the U.S. Higher interest rates will only make it worse. So the big home builders that are financially stable, that have great balance sheets, all keep hitting 52-week highs. All of them keep hitting 52-week highs. And you still have a shortage of housing, because the smaller builders simply can't afford to float the land and float the development costs of building a house for that period of time with the rates where they happen to be. So that's a kind of an interesting observation that could restrain aggregate supply. So if we're looking for a Fed pause because they're saying, hey, look, the banking sector is doing our job for us, this paragraph is sort of countering that, saying, it could also cut back supply. It could actually become part of the problem, not part of our solution. Participants judged that risks to the outlook for economic activity were weighed to the downside, although a few noted that risks were two-sided. Interesting. In discussing sources of downside risk to economic activity, participants referenced the possibility that the cumulative tightening of monetary policy could affect economic activity more than expected, and that further strains in the banking sector could prove more substantial than anticipated. Regarding risks to inflation, participants cited the possibility that price pressures could prove more persistent than anticipated because of, for example, stronger than expected consumer spending and a tight labor market, especially if the effect of bank stress on economic activity proved modest. A few participants cited the possibility that further tightening of credit conditions could slow household spending and reduce business investment and hiring, all of which could support the ongoing rebalancing of supply and demand in product and labor markets and reduce inflation pressures. Wow, that is just somebody who fell asleep for a while, woke up and said, I need to participate, otherwise people will think I'm lazy. Hey, maybe high interest rates might slow down the consumer and business investment. What do you guys think? Well, thank you for the Economics 101 lesson. I don't know why that's in there. A few participants cited the possibility that further tightening of credit conditions could slow household spending and reduce business investment hiring. Isn't that the whole point of what you've been doing for the last year? You're just getting it now? I don't know. Maybe I'm reading it wrong, but it's a funny paragraph. A number of participants noted the banking sector was well capitalized overall, and that I kind of like this paragraph, and the most significant issues in the banking system appeared to be limited to a small number of banks with poor risk management practices or substantial exposure to specific vulnerabilities. These vulnerabilities included significant unrealized losses on assets resulting from rising interest rates, heavy reliance on uninsured deposits, or strained profitability amid higher funding costs. So, combined with what they said earlier, banking sector, sound and resilient, nothing to see here. What you saw, few bad actors. In every industry, there are a few bad, mismanaged businesses, and that's all we saw. That's all there is to see here. Let's move on. It seems that they say this could cause credit to tighten, which could be the equivalent of a couple of rate hikes. And then they turn around and say, nothing to see here, just a few bad banks, nothing going on, everything is fine. Well, which is it? I'm a little confused. They seem to want both sides of it. In their consideration of appropriate monetary policy actions at this meeting, participants concurred that inflation remains substantially elevated relative to the committee's longer-run goal of 2%. Economic activity had expanded at a modest pace in the first quarter. Labor market continued to be tight. Robust job gains in recent months. Unemployment rate remained low. Against this backdrop, all participants agreed it was appropriate to raise the target range. All participants agreed it was also appropriate to continue the process of reducing the securities holdings as described in the plans for reducing the size of the Federal Reserve's balance sheet. In discussing the policy outlook, participants generally agreed that in light of the lagged effects of cumulative tightening in monetary policy and the potential effects on the economy of a further tightening in credit conditions, the extent to which additional increases in the target range may be appropriate after this meeting have become less certain. When we're thinking about financial conditions, we can't just think of debt. You can't just think of banks. You also have to think of equity. And I think in my Q&A video yesterday, I mentioned there was a company that just, a private company that just got funded, another round of funding, $444 million, AI based. So if you have this private money rushing in the venture capital space, every time a company gets $100 million, they got $100 million to rent facilities, buy computers, hire people, right? So when we think about tighter financial conditions, debt is just one side of spending ability. There's a whole amount of equity on the other side. And if there is this gold rush, and I heard it compared to that after the bell in an interview, that AI is the modern gold rush. Money is just rushing into and financing almost any company that says, hey, we got an AI this or an AI that. It's kind of like the .com thing, where if you said, I have, our business is based on, on an online model, money was thrown at you. We'll figure out who the winners are later, but we got to get in on this right now. The faster we can IPO you, the market's hot, everybody wants this. So when we're talking about further tightening in credit conditions, that could be completely offset by a complete loosening in equity conditions. Because if I have $1 million sitting in a bank, it's not inflationary. But if I invest $1 million in a business, they got to buy stuff. They got to hire people. They need a location. They need services. They need data center stuff. They need server capacity. They need all of that money will be spent. It suddenly becomes inflationary, but no credit was extended. I think that is going to be a bigger part of the conversation going forward, is that, we can't just look at banks and credit conditions there. Not only that, we keep hearing about private credit has a lot of money and is willing to step in and fill the void. And by the way, in the financial crisis, private credit did step in and fill a lot of voids where banks were unwilling to lend. So when we get to the commercial real estate space, if private credit is going to step in there, it may not be as big a negative for banks as we think if private credit steps in. I don't know. But that capacity is there. But I think the intersection right now of where the economy is and the fight that the Fed is doing and the ill-timed rise of a potential disruptive technology. I mean, the people at the Fed has got to be saying, talk about timing. They couldn't wait a year, because I think that equity injections into these companies is going to be a positive for economic growth, which means it's going to be inflationary, and they're not going to get the easing in the labor market that I think that they're looking for. A few assessed that there were upside risks to economic growth. We had mentioned that earlier. So every minutes that we've read, it was always downside risks to growth, upside risk to inflation. A few are now moving over and saying, hang on a second, we got upside risks to economic growth. However, almost all participants commented the downside risks to growth and upside risks to unemployment had increased because of the possibility that banking sector developments could lead to further tightening of credit conditions and weigh on economic activity. Almost all participants stated that with inflation still well above the committee's longer run goal and labor market remaining tight, upside risks to the inflation outlook remained a key factor shaping the policy outlook. A few participants noted that they also saw some downside risks to inflation. So this paragraph is let's call it a transition in thought, a turning point in thought from everyone saying, or at least all the minutes previously saying, risks to economic growth are to the downside, risks to inflation are on the upside. Well, now you have some members saying, hang on, there is some upside risk for economic growth. It could move upwards more than we think. And there is some downside risks to inflation. It could move down faster than we think from here. Haven't seen that before. Well, there it is, right? Take into account these various considerations. Participants discussed their views on the extent to which further policy firming after the current meeting may be appropriate. Participants generally expressed uncertainty about how much more policy tightening may be appropriate. Many participants focused on the need to retain optionality after this meeting. By saying they want to retain optionality, what they're saying is, hey, don't say we're pausing. Don't say it. Let's keep the option. Instead of saying that the next meeting could be a pause, don't say it's a pause. It could just be we're going to skip a meeting. But that further hikes aren't off the table. That's what optionality means. Some participants commented that, based on their expectations that progress in returning inflation to 2% could continue to be unacceptably slow, additional policy firming would likely be warranted at future meetings. Several participants noted that if the economy evolved along the lines of their current outlooks, then further policy firming after this meeting may not be necessary. If it evolves along the lines of their current outlooks, that means unemployment moving up. If we don't see unemployment moving, now the jobs numbers are more important than ever. If we don't see unemployment moving up, that means it is not progressing along their current outlooks. Their current outlooks are the SEP, the Summary of Economic Projections, and we'll get new ones in June. But next Friday, we get the jobs report. Whew, Super Bowl, another Super Bowl event for financial geeks, right? Further policy firming after this meeting may not be necessary. This was an important paragraph. Some participants stressed that it was crucial to communicate that the language in the post-meeting statement should not be interpreted as signaling either that decreases in the target range are likely this year or that further increases in the target range had been ruled out. They are saying, hey, listen, Jerome, when you go out there, you make sure that they understand that we are not, this language doesn't mean we're cutting rates, and it doesn't mean we won't increase rates. Let's read that again, because it's the last paragraph here, the last sentence before their policy actions. It was crucial to communicate that the language in the post-meeting statement should not be interpreted as signaling either that decreases in the target range are likely this year or that further increases in the target range had been ruled out. Now that means the Fed funds futures curve should flatten right out. And so far this week, we have seen it flatten out. But I don't know if that is the not treasury, but the debt ceiling issue. By the way, today I was buying, I think it was 18-day T-bills, the 6.8% yield. I think it was 18. It settles in 2 days, the 25th, 6th, and 19 day. It expires in 19 days. 19-day T-bills at a 6.8% yield. Unbelievable what's going on the short end of the curve. I looked at it and go, I'm only getting, I think, 4.3 leaving my U.S. cash in IB. This is 6.8. I know it's only 19 days, but I tried to buy as much as I could. There just wasn't anything to buy. I think my order expired unfilled. I think I got 300 and some odd thousand filled, and that was it. But there was nothing. And it was just incredible. I hovered over the bid and the offer. It was like 6.8 on the bid, or 6.91 on the bid, 6.7 on the ask. So I went in the middle for a 6.8. Anyways, there's the minutes, yeah, I think we have an interesting market ahead of us. Nvidia, I think, is sort of a turning point here. But listen, while I still have you, I am troubled. Their guidance, I've never seen guidance raised almost 50% higher in sales than what was originally forecast. Their forward earnings on the forecast is something like $10. Even at $3.80, they're at a 38 times forward multiple. For a 50% growth, their PEG ratio below 1. This thing is not over. Unless you actually have a default in Washington, an actual default. this is going to keep the market elevated and may have the real possibility of pushing the S&P past that 42, because while many of the other stocks aren't going to go along for the ride, you only need those 5 big guys, the S&P 5, the S&P 6, is it? I don't know, to go, or S&P 7, throw NVIDIA in there, to go along and drag that market upwards. So I would be, if you're short, this is one of those things where the facts have changed, or potentially the facts have changed, and you should be ready to be tactical, which means you want to add positive beta somewhere. If you don't want to cover your short position, add positive beta somewhere. A great place to add positive beta would be either to buy calls on NASDAQ or sell puts on the NASDAQ while you keep your short position on the SPY, because if there is a pullback, well, one will offset the other. If the market does advance, one offsets the other. You're just sort of hedging it out, or whatever you see fit to do on your own. Yeah, I think we have an interesting market ahead of us, that's for sure. Jobs report on Friday morning, and you still have the ongoing circus in Washington. And we'll see how that plays out. If peace breaks out, if they get a deal, then along with the NVIDIA results, along with the AI euphoria, along with the narrative that the Fed is going to pause, I don't know. I think that risk in equity markets now is to the upside. If Washington comes to its senses, then I mean that's the only thing standing in the way of I think a break above 4,200. So be safe out there.